Good morning, everyone. Welcome to Schulze Asset Management's fourth quarter 2015 Distressed Securities webinar. My name is Lisa Hines, and on behalf of our 10-person team here in Purchase, New York, thank you for your time. Today, I'm joined by my colleague, Rob Winkler, and of course, our CIO, founder, and managing member, George Schulze. Before we get started, I'd like to remind all participants that this event is not for attribution. We will be making forward-looking statements. Please refer to important disclosures on page 31 of your deck. For the next 30 minutes, we will provide a brief introduction, or for many of you, a reintroduction of our firm, our strategy, and our consistent approach. We'll review what the macroeconomy handed us in 2015 and what we expect the markets to deliver in 2016. We'll discuss in depth our top best performing and worst performing positions of the year, both long and short, 10 positions in total. And finally, we'll wrap up with some concluding remarks before opening the meeting up for your questions. And there will be instructions on how to ask a question. With that, we'll get started. On page 2, you'll find a few summarizing points. You'll be reminded that George founded the firm in 1998, though his track record goes as far back as 1994. We've traded over $3 billion in the market value of securities since that time. We're very proud of that consistency of track record. We continue to be laser focused on distressed securities investing, long and short, up and down the capital structure of primarily U.S. companies in every phase of the bankruptcy life cycle. And as proof of our conviction, we continue to be among the largest investors in our own funds. What is particularly exciting for us is the new default rate we entered in 2015, led especially by commodities and energy, which we'll get into in greater depth. Many of you are aware that we have found and have extracted ourselves particular value in the past in post-reorganization equities. Looking ahead to 2016, we believe we'll see even more opportunities in credit, and we'll position and reposition the portfolio as appropriate. You will recall that we invest opportunistically. Finally, we believe that full transparency is key to best-in-class institutional quality asset management, and we'll hope that we will demonstrate that here today. Moving on to our Q4 15 portfolio highlights. You are no doubt aware that 2015 was a tough year for active management. Certainly our fund was not immune given what the markets handed us. Even though the fund underperformed the broader markets in 2015, we believe that we are well positioned with value equities on the long and the short side as we move forward to 2016. There was full attribution later on in this deck, which we'll get into again in greater depth with full transparency. What is important in terms of portfolio highlights is the evolution of the portfolio, which we'll speak to in greater depth. We started out the year 136% long post-distressed equities and ended with 94% long post-distressed equities. We started out the year short 21% short equities and ended the year short 10% short equities, with the remainder in long distressed loan and bonds and warrants, again, investing opportunistically. And there's full transparency here on page 3. In 2015, our long post-distressed equities book generated losses which were less than offset by gains from our book of short-sold stocks issued by firms heading into trouble, heading into distress. There's a little bit of a recap of our 3-bucket portfolio construction that you'll see here on page 4. Many of you know this slide very well, and we continue to be very consistent in how we approach portfolio construction. If you'll turn with me to page 5, I'll turn it over to George, who will discuss our broad market outlook and certainly our outlook for 2016. Please, George.
Thank you, Lisa, and thank you, ladies and gentlemen. Good morning. Quick review here. As you may know from prior calls, the way we run these calls and this webinar format now is that there's a slide deck and there's also a copy of our annual report released on Syntrack simultaneously. which has much of the same information except a little bit more detail. If you put 5, some key bullet points from 2015, the S&P was about flat for the year, although it saw lots of volatility. There was very weak market breadth during the year, and clearly commodities entered a bear market in 2015. Having said that, unemployment is at about 5% as of year end, and core CPI has been reasonable, between 0.2 and 0.3%. And as a result, the U.S. Treasury bond increased to yield about 2.27% by year end 2015. Right now it's at about 1.78%. I think most investors on the call know that the Federal Reserve, the U.S. Federal Reserve, raised its benchmark interest rate last year during December by a quarter point. And at the time, there was a big expectation that we'd see 3 to 4 more increases during 2016. Since then, we've seen a lot of market volatility, a lot of uncertainty coming out of emerging markets, especially China, and additional turmoil in the commodities market. So it's unclear whether we'll see 3 or 4 interest rate increases this year. Maybe we get 1 or maybe none at all. We shall see. But we think either way, we are still in an extremely accommodative macroeconomic environment where interest rates are near record lows, and if the Fed does act, they will act in a very slow and cautious way. Having said that, we think that there are some excellent values right now in equities, post-distress equities specifically, and as Lisa just mentioned, there's a growing opportunity to look at credit for companies that are entering distress, and also for shorting companies headed into trouble. I won't spend much time on page 6. On page 7, I did want to make the point that our portfolio is evolving. And you can see with the default rate starting to climb significantly late last year that we're starting to get many more companies that are entering distress, and so it's a natural time for the portfolio to evolve. If you turn to page 8, one takeaway from this slide is that clearly commodities, energy, metals, and mining are leading distress, and you can see that on the right-hand side of the page where nearly every company that's listed in bankruptcy is in the metals and mining and energy space. There were 19 mega bankruptcies last year. Mega bankruptcies are defined as those that have over $1 billion in assets, and even though you're not seeing the same kinds of bankruptcies that you saw in 2008 in terms of size, there's clearly a lot of activity. We expect the default rate to rise to about 4.5% during 2016, and if oil prices stay where they are in the mid to low $30 per barrel, we would expect the default rate in the oil and gas space to exceed 20%. As an example of one recent default, a company called Energy 21 just defaulted. That's a medium-sized E&P company. They just entered the grace period for not having paid interest on their bonds. Turning to page 9, a quick overview of the different sectors and industries where we see distressed activity. Some of these are pretty straightforward. I did want to highlight in the auto manufacturing space, companies like GM and Fiat, we believe represent outstanding values right now. On the short side, in the same industry, VW looks like it's going to have more problems going forward with its emission scandal. In the casino space, we've been active with a company called Tropicana and also shorting a company called Caesars. We'll talk about that in a moment. In the coal space, there's just an extreme amount of distress. Right now, Arch, Alpha, Patriot, and James River Coal are all in bankruptcy. We believe Peabody will eventually go into bankruptcy. There's some interesting values there, and we'll talk about that a little bit more through this presentation. And we also highlighted it actually a lot more in a recent webinar that we had about the energy space a few weeks ago. You can get a copy of that presentation on our SynTrack website as well. In the energy space, I just mentioned Energy 21, but other companies that are worth noting include Chesapeake, BP, Benu, and many others. In the financial services space, there's a changing dynamic for companies that have emerged from distress, and we currently have positions with Bank of America and Citigroup. On the government side, of course, the biggest news is still Puerto Rico, but Detroit made it through and was out of bankruptcy for most of last year. In the industrial space, we'll talk about Lyondell in a moment. On the litigation claims category, we'll talk about Winn-Dixie at the end of the presentation, but we also have a position in a company called the Motors Liquidation Trust, which arose and was formed through the General Motors bankruptcy. In the publishing space, we're seeing more distress again. We have a holding called Carib Media that I'll talk about in a few moments, but recently a company called Dex Media, which is the largest U.S. Yellow Pages publisher, went back into distress and stopped paying interest on its debt. So with that background, let's turn right into some of the highlights during the year. As Lisa mentioned, we'll be talking about the top 5 losers and the top 5 gainers during the year. With Benu, we were simply too early with this company. This is an E&P company, an oil and exploration and production company, which went through bankruptcy a short while ago, and we held this as a position last year. Our average weight in the portfolio is about 2.3%. We reduced it a fair amount during 2015. It was our worst position. It cost us almost 4% of P&L during the year. By way of background, the company was formed when ATP Oil and Gas went through bankruptcy, and the senior debtor in possession lenders foreclosed on its assets. At the time of its bankruptcy filing, that company had about $3 billion in debt, and that was reduced to a current balance of only about $480 million as of today. Even though the Benu balance sheet was much cleaner than before, its stock and its post-reorganization debt dropped substantially during 2015 because of the terrible fundamentals in the oil and gas space. And so we did reduce the position substantially. Importantly, we also initiated a whole host of new short positions in energy companies during the year. And it's a long list. I'll name a couple of the companies: Pioneer Natural Gas, Energy 21, which we already spoke about twice now, Ultra Petroleum, which we just covered a few days ago, Clayton Energy, Chesapeake, Pacific Drilling, Comstock Resources, Denbury, W&T Offshore, Callan Energy. It's a really long list. There's lots of companies that have exposure to this space, and we've done very well with shorting them. We've also been short a number of companies that service these industries, companies like Basic Energy and Tidewater. We discussed both of those on our recent energy webinar, as well as Transocean. Let's switch gears and talk about the publishing space on page 11. Carib Media was a very interesting position for us last year. I think the most important part of it is that nobody else is focused on this credit, or most people aren't focused on this credit at all because of its size and because of the hair that it has. The stock cost us $0, and last year the company paid $116 per share dividend. Right now we're holding it at $80 a share, and we think that the company is likely to pay another dividend in the near future. The average weight of Carib Media in our portfolios was 0.8% during the year, but it generated positive P&L of almost 2%. As background, Carib was one operating subsidiary of a larger company called Local Insight Media, which was owned by the private equity firm Welsh Carson after it was spun off from Altel in 2006. Back then, Yellow Pages businesses were thought by many to be excellent cash-flowing businesses that could support substantial debt. Of course, that all changed with technology when Google and other online offerings eliminated the need to pay for directory listings. So Local Insight Media filed for bankruptcy in 2011 with about $1.5 billion in debt, and its Carib Media subsidiary had almost $200 million in debt, and it reorganized separately. The company focuses on Puerto Rico and the Dominican Republic. It also has the right to receive royalties from any directories that are published in Puerto Rico through 2046, so it has a little monopoly there. It is a small business. It generated $55 million in revenue for the 12-month period ended September of last year. And in its bankruptcy restructuring, about 127 million of old lender claims swapped their debt for 55 million of new term loans and 90% of the company's newly issued stock. As I said, the company paid $116 per share dividend last year, and we do expect it to likely pay more dividends going forward. Switch gears to page 12 and talk about a short in Caesars Entertainment Corporation. This is an interesting trade. First of all, it generated good profit for our fund. It added 1.1% to P&L during the year, and it was average weighted about 3.5% for the book during the year. The thing that's interesting, though, about it is that most other funds have not played this as a short opportunity. Most other distressed securities funds have been long in the distressed debt of Caesars Entertainment, and so I think we do have a very unique approach here. Most of our investors, I think, know that when U.S. companies go into bankruptcy, shareholders rarely get any recovery at all. And we think Caesars will be a similar situation. Our average cost for this stock is about $12 a share. Right now it's trading at about $7.85, but we think it's worthless. The company's main operating subsidiary, CEOC, filed for bankruptcy in January of 2015. And the background here is that Caesars was acquired in an LBO several years ago for $31 billion in proceeds. It was highly levered and has continued to stay highly levered, but as conditions worsened over the years, its private equity sponsors oversaw multiple transactions to split the company into two businesses, a so-called good business and a so-called bad business, and the bad business is now in bankruptcy. There have been a whole host of lawsuits related to these transactions over the years, and we think that when the dust finally does settle, that shareholders of this holding company, Caesars Entertainment Corporation, ticker CZR, will ultimately be heavily diluted or wiped out entirely because the company simply doesn't have enough cash even to support its restructuring support agreement as drafted. Right now, just as additional background, the company trades at almost 33 times total enterprise value to EBITDA, but sort of an absurd valuation, and we do expect the stock to go to zero eventually. For investors who want to dig into this a little bit more, we can share our model and share some more discussion. There's also more information about this in our quarterly letter. But let's switch to the auto industry for now. Excuse me, with Fiat Chrysler on page 13. A couple key takeaways about the auto industry and why we still like auto industry post-reorganization equities. Auto financing is readily available, and interest rates are still near record lows, even though the Fed has started to raise rates ever so slightly in December. Fiat has a terrific CEO, Marchione, who's done a great job, and we do not believe that the auto industry is dying in any way. Although last year, seasonally adjusted automobile sales hit a new record, we believe that the case can be made that that's not a peak, but it's only a new plateau which will stay at that level for some time. And the reasons, there are a number of reasons to support that opinion. One is that auto financing is readily available and interest rates are extremely low. Also, the low price of oil is driving gas prices lower and lower, and so consumers can afford to drive more. In the United States, the fleet of existing cars is also very old. It's about 11 years old on average, so people need to buy new cars to replace their aging vehicles. And used car sales prices are very strong right now. Also, capacity utilization in U.S. plants is near record levels. So you're not seeing a slowdown yet at all with production and demand, and inventory trends are good, and so are average selling prices. So with that as background, we think the economists and people on Wall Street that are questioning the auto industry in general and calling for a sharp drop from here we think they've thrown the baby out with the bathwater for some of these post-reorg equities in the auto space. Fiat's one of our best ideas at about 14.9% of the portfolio, and it did generate returns for us, positive returns of about 3% during the year. Over the years, Fiat management team has made some has done some very smart shareholder-friendly things, including acquiring Chrysler at an extreme discount after Chrysler eliminated about $20 billion in debt through bankruptcy. Also, early this year, Fiat management spun off its Ferrari business to Fiat shareholders, and we think that was a good catalyst to create additional value as well. The final point I want to make about Fiat is that it trades at only 1.6 times EBITDA, which we think is just absurd. To be able to buy a strong company like this at a price of less than 2 years worth of its current cash flow, we think is just absurd, and we expect to have some pretty good gains from this position in the future. Switching to the telecommunications industry on page 14, Hawaiian Telecom is one that's a holding, a post-distress holding that we've had for some time. Our cost for Hawaiian Telecom shares is $8.79 per share, and it currently trades at about $22. This is also one of our best ideas at just under 15%. Unfortunately, it detracted from performance during 2015. For people who don't know the business, it's a telecom provider in Hawaii that's been in business for 130 years, and it's the 10th largest incumbent local exchange carrier in the United States. Its business has evolved a lot over the past several years, ever since the bankruptcy, and then also before then. It was formerly owned by Verizon, and then at one point it was sold to a private equity firm for about $1.3 billion. Then, of course, it went through Chapter 11 in 2008, and through its restructuring, it was able to eliminate $1.2 billion in debt with pre-petition lenders getting the newly issued stock, as well as their pro rata ownership of an exit loan when it came out of bankruptcy. At the time, we opted to receive more shares, and as such, we were able to get more stock in Hawaiian Telecom at a discount rather than our pro rata stake in the exit loan. Since then, business has changed a lot. The company was listed on NASDAQ originally, then later was added to the Russell 2000. Management was successful in freezing the pension plan and executing a new union agreement. The company also made a couple acquisitions which helped with building out their network and fiber capacity. And those acquisitions also gave the business new cloud and data co-location service offerings. I think the most important thing, though, with Hawaiian Telecom is that they're also offering high-speed internet, video, and next-generation TV services. So they've really transitioned the business for growth. Finally, Hawaiian Telecom spent about $25 million adding fiber capacity through a trans-Pacific fiber optic cable that's been laid down across the ocean between California and Asia. That cable will give the company 2.6 terabytes of operating capacity, and they've already recouped their entire cost for constructing that cable by pre-selling capacity. Right now, this business, which happens to have a pretty large NOL of about $100 million as well, it trades for only 3.86 times, and its peer group trades on average at about 6 times. So we think, despite the fact that it detracted from performance in 2015, we think that Hawaiian Telecom has a lot of upside still. Turning to page 15, we lost some money in Hewlett-Packard, which is a business we've owned, which we bought after it plunged on disclosure of an $18 billion write-off. Since then, the company has done some very good things for turning the business around. Most recently, the company spun off Hewlett-Packard Enterprise Company, ticker HPE, and retained the remaining mature printer and PC business, which we kept on the balance sheet of our fund for some time. But last year, as this position started to detract from performance, we cut the holding entirely. Turning to the chemical space on page 16, Lyondell. Our cost for this position is about $30 a share. Right now it's trading at close to $80 a share, and we think it's still very cheap. It did generate some positive performance for our fund last year. Because it dropped off from about $100 a share, we did reduce it though. Right now it's at about an average of 5.7% of our fund. This company has extremely shareholder-friendly management. After they eliminated $17 billion in debt through restructuring, they've just delivered on numerous fronts. They recently achieved record-setting EBITDA. They've been repurchasing billions of dollars worth of stock. They've increased their dividend multiple times, and they've also paid a number of special dividends. The business currently trades at about 5 times EBITDA, which is a big discount to its peer group, and the stock happens to also yield a dividend yield of 4%. So a couple more businesses. Micron is a position that underperformed during 2015. Like Hewlett-Packard, we eliminated this position with a loss. We think our thesis made a lot of sense with Micron, but unfortunately the sentiment turned quite pessimistic. The company acquired a firm called Elpida Memory out of bankruptcy, and that was one of the largest bankruptcies ever in Japan. When we made an investment in Micron, it had an NOL of over $10 billion. And part of the thesis was that the consolidating industry would start to garner a lot more profits than before because of the number of competitors in the space was down substantially. But unfortunately, the sentiment remained pretty pessimistic during last year, and Samsung made some sort of irrational moves by expanding capacity, and so the stock sold down, so we sold the position. Switching to the shipping industry, most investors in our fund, I think, know that we were short Overseas Shipholding Group. Our average cost for this position is about $6.50 per share. As of today, it's trading at about $2.30. This was our best short idea last year. And in fact, I don't think many other funds were shorting this stock, especially distressed securities funds, because it was simply not easy to do. There's a capacity issue. If you have a multi-billion-dollar fund, it's not easy to short a company stock like this. And I think that says something about our fund's ability to be nimble. Our average position for Overseas Shipholding Group was just under 5% negative short, and it contributed about a 1%, 1.1% to our fund's P&L for the year. This is a global tanker company. It transports crude and other petroleum products in the U.S. and in international markets, and it filed for bankruptcy in 2012 and emerged in 2017. The company was able to eliminate almost $2 billion of debt through its restructuring, and at the time it issued almost 530 million shares of new stock in exchange for about $2.50 per share of cash from certain new investors. So as usually happens, pre-petition shareholders are usually wiped out or substantially diluted. In this case, they were diluted by 94%, but old shareholders also received the right, through ownership of Class B shares in OSG, to receive a portion of the potential recovery from a malpractice lawsuit against the company's old law firm, Proskauer Rose. We looked at that lawsuit, we analyzed it very carefully, and we concluded that there would be very little recovery from that lawsuit. So we maintained a short in the Class B shares. During 2015, meantime, the company's overall fundamentals improved substantially, and its cash flow increased. So we also took an offsetting long position in the company's Class A shares. So in effect, we had a dual position. We were short the litigation while we were long the recovering economics of this company's industry. And so in early this year, we're happy to report that the company finally settled its Proskauer case for only 16 to 18 cents per share, and that we are going to realize this position now. The final holding I want to talk about is Winn-Dixie Stores. Some investors, I think, on this call probably recall that we used to own this position many years ago. In fact, we've been an activist investor with Winn-Dixie dating all the way back to 2009. The company is a major food retailer that operates in the southeastern U.S., mostly in Florida, with about 480 stores. We've had a lot of success with it as an activist investor, but last year we did lose a little bit of money with it. The company initially emerged from reorganization several years ago after eliminating about $1 billion in debt. And since then, we became very activist, trying to encourage the board to close what we thought was an obvious valuation gap between Winn-Dixie and other similarly positioned companies. As I said, we had a number of successes. We were able to get them to include our proposal on their proxy, despite their best efforts to keep it off. Later, the majority of shareholders voted to agree with us. And then in the end, because management was unable to close the valuation gap, we helped them create a catalyst to sell the entire business. Unfortunately, we found out that the board had done some strange things at the time. They were looking to sell the business, and they had actually turned down a higher offer from the very same buyer they agreed to sell it to. And so we started a class action lawsuit against the company. But unfortunately, at the end of last year, we lost the ultimate appraisal proceeding that came out of that. So we gave a little bit of money back in Winn-Dixie in the end, but we did have pretty good long-term success with the business overall. So that'll conclude my remarks about specific holdings. Let me turn the call over now to Rob to conclude and open up the Q&A.
Thanks, George, for your market outlook and portfolio highlights. 2015 was a tough year for a lot of managers, and our fund was no exception. However, the market sell-off has created opportunities where we're finding good companies at lower EBITDA multiple. Due to the collapse in energy market, our team found a treasure trove of companies that appear to be heading into distress. For 2016, we believe long-term investors should continue to do very well in U.S. equities as the markets have become cheaper and make it an attractive entry point for clients who have capital sitting on the sidelines. Within stocks, post-reorganization equities, in particular, offer compelling values and big upside appreciation. Here, at Schulte Asset Management, we strongly encourage investors to consider new investments at this time. Our experience is that over the years, those clients who have invested new capital with us during the market corrections have had much better long-term results. Thank you, and now I'd like to open the call to any questions you may have. To ask a question, please press the hand symbol on the upper left-hand side.
All right then, everyone, it looks like there are no questions at this time. We certainly welcome your thoughtful questions and comments and feedback at any point. You are aware that, again, we believe in full transparency and that the entire team, including George himself, is accessible for, again, any of your comments and questions and feedback. And again, we look forward to updating you as we evolve and progress to 2016. And if there's anything further that we can offer, please don't hesitate to ask. We thank you again for your time today and look forward to our further dialogue. Have a great day.